Good morning. Today is Wednesday, October 7th, 2020, and thank you for joining us for another edition of the Market Commentators podcast. My name is Andy Wilms. I'm president and CEO of the Milwaukee Company, and joining me once again is Mike Wilms, who is our Chief Operating and Compliance Officer. For those of you who are familiar with our podcast, you may be wondering what's happened to our video feed. Well, we've decided to switch to an audio-only format at the recommendation of our executive producer.
Executive producer? Who the hell's that?
Well, that's none other than our quantitative analyst, Jake Wilms.
Well, I mean, I would advise Jake not to quit his day job here.
You don't think he has a career as an executive producer of our podcast, huh?
Well, I don't know how far we're going with the podcast, but
I think you have a point there, Mike. But anyway, before we get any further, let me just remind viewers that nothing in this podcast should be considered to be investment advice, and the views we're going to be expressing are those of your or my personal views, and not necessarily those of the Milwaukee Company. And on that happy note, I'll begin with a recap of what's happened since we last talked. The month of September came to a close, of course, last week, and September lived up to its reputation as a bad month on Wall Street. A tech-led correction at one point pushed the NASDAQ down by over 5%. The S&P was down almost 4%, and the Dow Jones had lost about 2.3%. So we ended up, September was a dark month, but while the S&P is still 50% above its March low, it's now 5% low. It was 5% at the end of the month, 5% lower than its all-time high at the end of September. U.S. stock markets were whipsawed about as lawmakers debated new pandemic relief aid, and as a result of President Trump contracting COVID-19, high unemployment rates, and growing rates of infections in some areas, including here in Wisconsin, which has been a particularly hot spot. For the week, the U.S. stock market rose about 2%. Investment-grade bonds were about flat. And the strongest of all the different sectors was the real estate sector. The Vanguard Real Estate Tracking ETF, VNQ, was up almost 5%, or over 5%, excuse me, almost 5.5%. And this week is kind of more of the same, with the stock market being whipped around by political developments. We had on Monday, the stock markets did well based on President being released from the hospital, and the thought that maybe this would help with the stimulus deal because he actually came down with the virus, and also Biden's lead over Trump was widening. So people were thinking, well, there's less chance for a contested election, which was a drag on market performance. But then yesterday, the markets sold off sharply because there was concern that President Trump said, that's it, no more negotiations on a stimulus deal. He pulled the plug on it, it appeared, but then last night, he sends a tweet out that says, well, he would sign a bill that would give everybody a check for $1,200, apparently whether they need it or not. So it looks like there might be more money for millennials and Generation Z investors to deposit in their Robinhood account.
The key thing is just to keep in mind what the magnitude of the numbers are, Andy. Mnuchin, Republican White House proposal is in the $1.5, $1.6 trillion area. Democrats are holding firm. Nancy Pelosi won't agree to anything less than $2 trillion. And the entire 2021 federal budget was originally pegged pre-pandemic at $4.9 trillion. So we're talking about a 40% increase in the additional stimulus being proposed. And that's on top of the $3 trillion that's already been passed and distributed. So, I mean, it's essentially a doubling of the federal budget.
Which is really shocking and kind of brings back to mind Ronald Reagan. I think it was Ronald Reagan who once said $1 billion here and $1 billion there. And next thing you know, you're talking about real money. I wonder how we feel about we're talking $1 trillion here, $1 trillion there. I mean, billion has become what you like to refer to as decimal dust almost. I mean, it's really, really something else.
There needs to be an understanding on how all of this will carry forward into the markets in the future, with lugging around 28 or $30 trillion of federal debt.
And that's right. You know, it means all the stimulus is good for the market now because the money's got to go somewhere, right? So the money that's not going to pay groceries or the electric bill, when you give everybody money, whether they need it or not, a lot of that money is going to find its way into the stock market. So it's going to push stock prices higher in the short term. What is problematic, in my view, is, as you're pointing out, the impact on the long term. It might be very good for the economy for the next year or two, or even three. But 5, 6, 10 years down the road, I'm not so sure.
Last week, they announced consumer spending rose in August, but unfortunately, income fell sharply relative to the federal unemployment expiring as of July 31st. We had U.S. manufacturing activity ease in September, but is continuing on a solid rise. As of yesterday, when I looked, the Atlanta Fed's GDP now still predicting a 30% plus increase in GDP, which is directly tied to manufacturing. The bright spot has been the U.S. construction spending, with housing doing extremely well. A big part of that's going to be driven by Federal Reserve and the purchasing of mortgage-backed securities and a reduction in mortgage rates. Home affordability, whether new or used, it continues to go up as interest rates go down. U.S. jobless claims still not a bright spot. Initial unemployment claims last week came in at 837,000. While that's down over the last couple of months here, it's still, if you pre-pandemic, the largest single weekly increase in unemployment claims was 665,000. Last week, the House Democrats passed their version of a $2.2 trillion stimulus. That's kind of tying back to our previous discussion about the size of the stimulus that's on the table. And to your point, COVID-19 infection has spread in certain areas. The infection rates are picking up. There's concern about the potential of further economic lockdowns, and that would have a negative impact on the various things that we just mentioned, with unemployment claims potentially going up and economic activity taking a hit. So, it's something that we need to be watching closely. And, there just seem to be some hot spots here that hadn't been previously. Past Saturday, 4 states, Kentucky, Minnesota, Montana, and unfortunately Wisconsin, saw record increases in new cases. Some of the parts of the country that had virtually no new infection rates, North Dakota, South Dakota, they're now experiencing some of the highest per capita infection rates.
So I guess the one positive news is, even with the increase in infection rates, with a number of people contracting the disease, we're seeing a significant drop in the number of people who are dying from the disease. So
exactly,
there has been tremendous the improvement on the way we treat the disease. So hopefully that's going to offset some of the rise in the number of people contracting it. But as the number of people who get the disease increases, the odds are, or the risks of a more dramatic economic impact increase as well. And, it's surprising to me, Mike. I'd like to talk a little bit about with you how the gap that's opened up between how the banks and the bond market perceive the health of corporate America, because banks are, in the process of setting aside billions of dollars against bad loans, even when bond prices themselves have had a dramatic recovery from the original COVID-19 shock. And we've seen the difference in the yield in the U.S. government debt and corporate bonds now get to the lowest it's been since this whole pandemic crisis began, and with the spread tightening from almost 5 percentage points in March to well under 2% now. So,
well, and that's in the high yield junk bond
right.
arena. And those are not only pandemic lows, but historical lows. The corporate spreads across the entire credit rating spectrum are at all-time lows. They're as tight as they've ever been.
And, I think part of that you can explain by the fact that the Feds intervened in the corporate bond market, right? Which they had never done before, right? This was
correct.
And they're doing it in a big, bad way. They're really getting in there and bolstering the buying up corporate bonds, including, I should say, high yield junk bonds.
The place where they stepped in to really kind of create a backstop based on a perceived huge market risk was there's been such a huge issuance of triple B rated corporate bonds, which are the bottom of investment grade. And with drop in revenue and the effects of the pandemic, a number of those triple B issuers were downgraded to junk. The Fed specifically set up a program to buy those quote unquote recently downgraded junk bonds, which are characterized as fallen angels,
Right.
something that you know something about.
Yeah. And, I guess the thing of it is, there's only so much the government can do, right? The government can't buy corporate bonds indefinitely. I mean, they've set a 3-year window. They haven't really set a dollar amount as to how much they're willing to buy, but it can't go on forever. And, with the spreads getting this tight, I stand by my earlier suggestion that investors consider underweighting corporate bonds until we have more clarity on the whole COVID-19 situation. But maybe we should talk about a little bit of broader question, and that is, what role should bonds be playing in a portfolio at all? When we look at the old rule of thumb was, 60-40, 60% equities, 40% bonds. And I've seen a lot of investment advisors, portfolio managers coming out and saying, well, it's time for that 40% for investors to reconsider that 40% allocation to bonds, or whatever their individual percentage allocation might be.
In one of the financial publications, they had a interview with Rick Ryder, who's the chief investment officer at BlackRock. And we're back to the where we were talking about real money. BlackRock now manages $2.4 trillion in assets. Rick Ryder was saying that you're now to the point where you need to question the upside in holding 40% of your portfolio in traditional high quality bonds. That type of asset allocation is getting to be dubious on a risk adjusted return basis. And there's many participants in the market that are searching for the quote unquote alternative to traditional fixed income investments. They're exploring. I mean, to your point earlier, the REITs performed extremely well last week. REITs are an alternative. Utility stocks are an alternative. The scary place people have been looking for additional yield away from high quality corporate bonds or municipals has been the high yield market, even though that market is trading at a historically tight spread, which is a euphemism for higher risk. Emerging market bonds, I mean, people buying bonds in Africa and markets that were never considered previously. And then, swinging back here into the developed world, looking at ETFs and high-paying dividend stocks.
Yeah. The thing that concerns me, about all of these bond alternatives is, yes, we've talked in the past about the bonds that, having serving three purposes in a portfolio, right? Safety, yield, and diversification, right? And so you're right, these first two are kind of being jeopardized. Safety is being jeopardized because whenever rates are really low, you have more risk, right, in investing in bonds. And same is true with income. When rates are really low, they aren't giving you much income. But we got to be careful when we look at these other alternatives that they provide the ballast that bonds provide in a bear market, right? I mean, if it's a bear market for stocks, bonds tend to be a better place to be. So you just got to be careful. And I think these alternatives are fine as long as clients are willing to adjust their tolerance or expectations with regard to volatility. Because as you reduce your bond allocations, you're probably going to increase the volatility of your portfolio at least in short-term cycles. So you got to be very understanding of that. And, you might, one of the things you might just look at are as simple things as CDs. You know, there are CDs that are paying much higher rates. Well, much higher. They aren't paying much either, but paying higher rates than some of the government bonds are. So,
and that's exactly right. And not even just government bonds. If you look at we had looked at what a mutual fund reports as its SEC yield, which is the dividend yield that they're paying. And some of the fixed income bond portfolio, mutual funds and ETFs have SEC yields of just over 1%. I mean, 1.1, 1.2%. And sitting in a CD at 50 basis points and not having capital risk, that might be a pretty good trade-off. And then you briefly touched on, what happens when the Fed stops buying. And where they're currently supporting the market in all of the different areas, fixed income wise. People need to scroll back in their memory banks and remember what happened in 2013 when they started to scale back the quantitative easing and purchasing of treasuries and mortgage-backed securities in that time frame. Everything cratered.
It did. And the other side of this, though, of course, there is a good news in terms of these really low rates, and that is the ability to borrow money at very low rates. I mean, the 30-year mortgage rate is less than 3% right now, and after you factor in tax breaks and inflation, so you're basically paying nothing to borrow money right now on a mortgage, And so the question becomes, does it make sense to take out a mortgage even if you don't need the money, since you're basically not paying a hill of beans to get it? I'm an old German, and we don't like to take on debt if we don't have to. But I'm becoming more comfortable with the idea of maybe taking out a mortgage and just to lock in these very low rates. I've been thinking about doing it, even though I'm fortunate enough not to have a mortgage on my house right now. I might be tempted to do it because it seems almost irrational not to when rates are so low.
Well, and I'm sure everybody is getting the teaser emails for 30-year fixed mortgage rates down to 2.5%.
Yeah.
It's really pretty amazing if you think about a real cost of the money. If you factor in inflation, if the Fed is trying to get to 2%. And you're borrowing at 2.5%. I mean, it's costing you 50 basis points in terms of a real interest rate what's your opportunity cost? How can you redeploy the cash?
Right. I think, though, for all of our listeners who might be considering this as an alternative or this possibility, they have to make sure you got the cash flow to service the mortgage, regardless of what the return is on the portfolio. Because that, if you're looking to borrow money on a 30-year note to make, short-term investments to try and time the market or speculate what the market's doing, that's I think a very bad and dangerous idea.
Exactly.
But if you're prepared to invest the money for the longer term, if I was taking out money, borrowing money to invest in the market, taking a mortgage on my home or home equity loan, I would say, you need a 7 to 10 year investment horizon. So you need to be able to ride out a complete economic cycle, market cycle with that money, and be prepared to service the debt without taking anything out of the money that you invested, because otherwise to me, it's the risk is greater than the potential return. That's just my personal preference, I guess. All right, Mike. Well, I think that brings us just about to the end of our allotted time. I did have one more question. Maybe you could touch on it real quickly, just because it's something we've talked about a few times here, and that is this high valuation of tech stocks and whether or not we have another dot-com bubble coming. Do you have any comments on, there's been a recent surge in all of this. Do you have any thoughts about that? Do we have another dot-com in your mind?
If you go back and think about the dot-com era, there weren't any traditional financial metrics supporting some of the stock valuations. It was a number of eyeballs that a internet company was their site was experiencing. I mean, you've got real earnings, you've got real revenue, cash flow, the things that growth investors can kind of establish and assign a valuation to, unlike the days of yore in the late 90s. And I think the dot-com bubble actually burst in March of 2000, right?
Yeah.
So,
well, then again, you got this, like, you got something like Snowflake that comes out, and its valuations were just outrageous. So I agree with you. There's probably, we haven't, believe it or not, we haven't had the same level of growth. Over the past 5 years, the Nasdaq's up 127%, which sounds outrageous, but that's kind of a pittance compared to the 456% rise there was in the Nasdaq during the dot-com era. So I don't think we're quite there yet, but I do think that these and we talked about this a couple of weeks ago, the fact that we've had such concentrated growth in just a few names is disconcerting, and maybe gives investors pause to investing in indexes that are highly concentrated in these 5 or 6 companies, like the Triple Q, like the Nasdaq, or even the S&P 500 at this point. And I think you probably heard yesterday, I did not look into the details. I just saw the headlines that they're talking about, bringing antitrust legislation to the table to go after these guys. And of course, if we have a Democratic sweep, the possibility of that actually becoming law, increases dramatically. So we could see.
And that's exactly right. I mean,
and that would be could be really, really bad for the tech end of the market. So I would still avoid over concentration in a handful of names, although they've done extremely well so far. I'm talking about Netflix, Amazon, Microsoft,
Apple, and Google.
Yeah. So again, it depends on what your investment objectives are. But for me, that the risk there is, while it's not like the dot-com era, it's a little higher than I would like.
Well, and I guess as an anecdotal, closing kind of comment, I mean, things are changing, and I think people need to understand that Amazon's balance sheet has got as much distribution real estate and plant and property as Walmart has in physical retail stores.
Right, but they're still vulnerable to what Congress might do to, in terms of the Sherman Antitrust Act, and that sort of thing.
Right.
But you're right that things are changing. The way the market behaves might be changing, and
the market looks at them and thinks about them.
What's that?
How the market looks at those companies and thinks about them, and the valuations that they assign.
Yeah, and I think the way the market behaves is changing, because the mentality of your investors are changing. And so we've had to do some changing around here, Mike, as you know, for the last 6, 7, 8 months or more. Right. I guess it's over a year now. We've been revisiting all of our strategies, because we've seen how these things how the strategies perform, the rules-based algorithms that we use to inform our investment decisions. We see how they've responded to a set of circumstances we've never experienced before. So, and as an investors, we have to be prepared to change with the market. I'm not saying we just do what's, change at the drop of a hat, but we have to continue to work diligently to revisit what we've done, see if we think the way we've invested our money in the past still makes as much sense in the future, and keep open to changes to the way we approach things as the world changes around us.
Exactly. I mean, the market is a living, breathing, evolving kind of thing.
Right. I mean, I remember when you and I started investing a long time ago, value stocks was the value factor was almost unquestioned, right? Everybody kind of loved to buy value stocks. value stocks have underperformed now for over a decade,
Exactly.
So you just got to be prepared to respond to what you see is going on. All right. Well, with that happy note, I think I'll wrap up for today. I would like to thank all of our listeners for joining us, and to remind them to keep in mind that nothing in this podcast should be acted upon until you've discussed it with a financial advisor who's familiar with your own personal situation and investment objectives. So on that happy note, I'll wish everybody to have a great day, and thank you, Mike, for joining me this morning.
Thanks, Andy, and have a great day, everyone.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.